Last year, Vanguard released the latest version of its white paper that attempts to estimate the value that a good financial advisor can add to the average investor. They put that value at the equivalent of 3% per year net of fees, which is a massive figure. Now, although I do agree that a good financial advisor can add that much value, if not more, it is highly dependent on your individual circumstances. It's a spectrum. For some people, it can be hugely beneficial, whereas for others, less so. So in this video, I want to help you work out if you are the type of person that could be set to benefit. Because if you can see results anywhere near this, that could enable you to retire years earlier and with a substantially higher income. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner and partner of a financial planning practice based in London. Because of this channel, my business and I are fortunate enough to have a lot of people reaching out to us for help with their finances. But before we start working with you, we first need to assess whether you are likely to get value from working with us. That is what we're trying to establish in that first meeting, because from your perspective, you obviously don't want to work with us if we're not likely to add value. But if that is the case, well, I don't want to work with you either, because it takes a huge amount of time and effort to onboard a new client. And if that relationship is only going to be short-lived, it's not worth pursuing, especially when there is a long line of other people who would really benefit from working with us. So this video is to help you identify ahead of time whether you're the type of person who could benefit from working with a financial planner, so that you know when to get in touch. When you think about getting financial advice, I bet the first thing that comes to mind is the fees. What is it going to cost? Typically, you can expect to pay about 1% more per year in total fees than if you did it yourself. It often tiers down from there the more money you have, but let's just go with 1%. Knowing what you're going to pay is important. But if that's the only question you're asking, you're missing the point. What we really need to work out is what value are you likely to get for those fees? And that comes in two parts. There's the objective value, how much better off in pounds and pence are you likely to be? Then there's the subjective value that you can't put a price on and that only you can determine. This Vanguard study has tried to estimate what the objective value might be for the average investor, and they put that at 3% net of fees. But they're not saying that you can only achieve that if you work with a professional. What they're really trying to demonstrate is how powerful good financial planning can be if done correctly. And what they're trying to highlight is that most people don't do it. Perhaps because they don't have the time or knowledge, but I think it's mainly because most people don't know what good financial planning outcomes actually look like and what it takes to achieve them. My whole YouTube channel is designed to help you understand what good financial planning looks like, so that you can either go, okay, well, I'm not doing that, but I'm going to start, or you realize, okay, well, I'm learning a lot here and the consequences of me getting this wrong are high, so that you know when to reach out for help. Because the delta between good financial planning and the average investor's journey is huge, which is why hiring someone to do this properly can be well worth the costs. Vanguard is in a unique position because they have people on their platform that use advisors and people that don't. So they have used that data alongside other studies to try and put a figure on the objective value of advice and how it's delivered. However, this comes with some big caveats. Vanguard has equated the value to a percentage-based figure because it's easier to conceptualize. But although some value can be expected every year, the rest of it will be lumpy, coming during specific events or tax planning opportunities. And from my personal experience, although I do think it's possible for people to see this much value, it is highly dependent on your personal circumstances. So later on in the video, we're going to talk through the types of people that are likely to see the most benefit. But first, let's try and understand what good financial planning outcomes actually look like and how, in the world of low-cost index investing, it can still add value. Most people think that working with a financial advisor is all about beating the market. They think that a good advisor will help you select a set of investments that are likely to outperform. This is the traditional view of financial advice because that is what advisors used to try and do. In fact, many still do. But we now have decades worth of data to show us that financial professionals can rarely deliver a return that beats investing in a low-cost passive fund. But what's interesting about this Vanguard report is that none of this potential value comes from beating the market. So if it's not about beating the market, what is it? You'll notice that I do not call myself a financial advisor. Although I technically am one, I call myself a financial planner because financial planning is very different to traditional advice. It's a much more holistic discipline that covers a huge number of different verticals. In fact, this Vanguard report only focuses on a few of them, when there are in fact many other areas that should be addressed as part of a good financial plan. Later on in the video, we're going to dive into some of these individual areas to see how they can each add value. But before we get into that, we need to recognize that even though good financial planning can help you achieve a better return and save you tax, that is not the end goal. When people first get in touch with me, they typically ask, James, can you help me sort out my pensions and minimize tax? Yes, I can, but why do you want to do that? Obviously, so I can get my money working harder for me. Okay, but why? So that I can retire. Why do you want to retire? Because in all honesty, I have sacrificed a huge amount to get to where I am. Sacrificed for my career, sacrificed for my family, and now I would much rather be spending my time with the people that I love, working on the things that I'm passionate about and visiting the places that I've never got to see. Okay, so what you really want is time. Quality time to do the things that you want. Yes. We must remember that the end goal is not more money. The end goal is time and getting the most out of what we have left. We too often lose sight of that. We assume that the end goal is more money, and that if we can only hit that figure that we have in our heads, that suddenly we'll arrive. That then we'll feel secure. Then we'll be able to enjoy ourselves. Then we'll feel fulfilled. But that is a false horizon. If you do not feel financially secure now, if you do not feel fulfilled, no amount of money is going to solve that problem. Unfortunately, we often only realize that once we've already traded far too much of our precious time in the pursuit of money or a lifestyle that will not fulfill us. Good financial planning is not about leaving you with more money. It's about helping you make the best use of the time that you have left. So the question that you need to ask is your financial planner doing that for you? Now, you might think, James, what are you talking about? I don't have a financial planner. Yes, you do. If you're not working with a professional, then your financial planner is you. So the question that you need to answer is, are you actually fulfilling that role? A good financial planner will help you to define your goals, to define the lifestyle that you want to build, and then work back from there to find the best way to achieve it. A good financial plan cannot eliminate uncertainty, but it will help you to recognize what you can control and what you can't, and then get you to focus on the things that matter and stop worrying about everything else. To stop worrying about whether you're doing enough. To stop worrying about what's going to happen when your mortgage rate rises. To stop worrying about what might happen to your family if you lose your job or you fall ill and are unable to work. To stop worrying about the next stock market crash and second guessing how you're invested, because that will all be part of the plan. At the same time, a good financial planner will help you to realize if you're sacrificing too much of the present for a future that may never arrive. Help you to zoom out and realize that maybe you should take that sabbatical or make that career change. Yes, you may end up earning less or have to work for even longer, but they'll help you to remember that the end goal is not more money. The goal is not to retire as soon as you can. The goal is to make the most of the time that you have. Tomorrow is not promised, so if you can find a lifestyle that gives you more purpose and more time to enjoy life along the way, that is what we're optimizing for. A good financial planner will help you to realize when you have enough and give you the confidence to act on it. Give you the confidence to stop trading your time for money and to feel good spending the money that you have sacrificed so much for. This sounds mad, but I spend just as much time trying to get my clients to spend money as I do trying to get them to save it. No matter how wealthy you are, the scarcity mindset runs deep. A recent study of US retirees showed that each year, 58% of them draw less income from their portfolios than their investments earn. 26% draw exactly what their portfolio earns, whilst only 17% touch their principal. This tells me that there is going to be a lot of competition for the wealthiest person in the graveyard. What a tragic waste of time. A good financial planner will give you the confidence to stop when you have enough, and then in retirement give you the confidence that you can spend money or give it away without it jeopardizing your future, ensuring that you make the most of those precious healthy years of retirement or support your family when you're actually around to see them benefit from it. You can do all of this yourself. You can be your own financial planner, but you just need to be cognizant of the fact that not only do you need to be good with all this technical stuff, but you also need to be good at calling yourself out in your own bullshit. Now, I don't know about you, but I'm not very good at that. If you look at the things that I say are most important to me in life, and then you look at the way that I spend my time and the way that I spend my money, you see two very different stories. And it's the same with most people, which is why I work with an advisor to help me align the way that I run my business and my life with the goals that I actually want to achieve. I need help getting out of my own head, to see past my own bias. I need to be reminded to stop worrying about things that I can't control and to think long term. And that advice is invaluable. I can't put a price on it. So if you're trying to work out if good financial planning is worth the costs, the question you should be asking is, what is the cost of not doing this properly? What is the cost of not saving enough for retirement? The cost of having to trade away more of your time and your health than you needed to? What is the cost of the time you spend thinking and worrying about money? These costs are subjective. For some, they will be significant. For others, less so. And only you can put a value on it. If you've never worked with a good financial planner before, you probably think that the only way to define the success of that relationship is how much more money you're likely to end up with than if you did this on your own, either through higher investment returns or tax savings. But when you actually ask people who use planners, how do they measure value? Investment returns are right at the bottom. Now, that's not because returns are unimportant. Of course they are. But what's more important is the peace of mind and sense of security that comes from knowing you're on track, that there's nothing you're missing. What they value more than investment returns is progress towards their financial goals, progress towards that lifestyle they're trying to build. Of course, good investment returns, tax savings, and all the technical stuff is a fundamental part of it, but that should not be the definition of success, although from the outside, it's easy to think it is. Vanguard has tried to put an estimate on what the objective value might look like for the average investor, just to highlight how beneficial good financial planning can be. But in reality, you will never be able to determine ahead of time, or even after the fact, exactly how much objective value a good financial planner will deliver. Because just as with any type of advice, whether that be from an accountant, a doctor, or a therapist, once you start receiving advice, we will never know what decisions you would have made on your own. Maybe you would have got better on your own, or ended up making exactly the same quality of decisions. But what if you don't? With all types of advice, it's a question of risk and understanding what are the costs of not getting it right. What is the cost of being underinvested? The cost of taking too much risk in retirement? The cost of not having the right insurance? The costs of not managing your mortgage properly? The costs of missing out on tax planning opportunities that could save you tens, if not hundreds of thousands of pounds over your lifetime? Making generalizations about the value of working with a financial planner is hard because there are so many different ways that we can help that benefit different people in different ways. But let's take a closer look at some of those areas where we often see the greatest impact. We've already covered the subjective stuff, which often ends up being the most valuable. Then there's tax mitigation and retirement planning. These are two of the biggest value drivers. Again, it's hard to generalize, but if you've been watching my channel for any length of time, you would have seen lots of examples of the mistakes people make and the opportunities that exist. The other big one is behavioral coaching. If you look at any study that tries to quantify the value of good financial planning, behavioral coaching is almost always the biggest value add, with estimates ranging from 1% all the way up to 4% per year. Our brains are not well equipped for the modern financial world in which we live. The heuristics and cognitive shortcuts that we relied upon to keep us alive in the past now lead us to make mistakes. There's recency bias, where we incorrectly assume that recent trends and events are likely to continue. Hindsight bias, where we convince ourselves that we predicted an event before it happened. Confirmation bias, where we seek out information or interpret it in a way that confirms our existing belief. Risk aversion bias, anchoring, mental accounting. Even when we are aware of these biases, we find it so hard to think objectively when our own money is at stake. Our biases affect the way that we think about saving money, insurance, debt, expected returns. It runs deep. We can see evidence of the damage that this can cause in the fact that the returns that investors receive are typically far lower than the funds that they invest in. Investors tend to chase performance, buying into investments after they have already performed well, and avoiding or selling ones that have performed poorly. So even though a fund may have delivered a good return over the long term, Because of these poor timing decisions, the returns that investors receive tend to be between 1.5 and 2% lower per year than the funds that they invest in. Although it can be even more extreme. Between 1973 and 2002, the average investor in the Nasdaq trailed the return of the index by 5.3% per year. This finding is consistent across both active and passive funds, which tells us that index funds have not solved this problem because people are still picking the wrong ones at the wrong time. Good financial planning is often just about helping you get out of your own way. So if by working with one, you can eliminate just this single aspect of poor decision making, it will more than make up for the fees that they charge. Now you might be thinking, but James, I would never make these mistakes. I am better than the average investor. Well, this leads me onto the worst bias of all, the hardest to overcome, and the most likely to lead to mistakes. Overconfidence bias, where we have the unfortunate tendency to overestimate our abilities and to think that we're better than average. Did you know that 85% of French men think they're better than average lovers? Unfortunately, they can't all be right. I asked you in a poll the other day how you would rate your financial literacy compared with the other people who watch my channel. And I knew what the results were going to say before I even posted it. Unfortunately, you can't all be right. And confirmation bias feeds this effect because we tend to attribute anything that goes well to the results of our skills, and anything that goes wrong as the result of some external factor that was beyond our control. The Dunning-Kruger effect describes how, as we start to gain knowledge in a particular field, our confidence tends to peak right at the start, when our competence is actually the lowest. But then, as you start to learn more, you realize, oh, okay, there is more to this than I thought, until you finally have enough competence to know that there are things that you don't know. And what we find is that people that do actually have high levels of competence tend to understate their abilities because they're typically surrounded by people that are even more competent than them, and they take their own knowledge for granted. A little bit of information is a dangerous thing, and these are the people that make the most costly mistakes. And what's interesting is that this effect is much more pronounced for those people that are highly educated in another field, or those with high incomes, which is typically the type of people that like to watch this channel. Studies also show that people with high confidence and low competence are the people that are less likely to seek advice. And even if they do, they're less likely to listen to it. Whereas we find that those with high financial literacy are much more likely to seek advice, and they're also more likely to benefit from it. And I see this in the fact that we work with a lot of fund managers, CFOs, and accountants. Keeping costs low is really important. Why? Because fees compound forever. But do you know what else compounds forever? Mistakes and missed opportunities. And for some, the risks and costs of making mistakes are much higher than for others. Firstly, people approaching retirement. I think I have about 50 videos on my channel specifically dedicated to retirees. And there's so much more that I need to share because this is where things get complicated and where the costs of making a mistake are highest. You need to be thinking about sustainable rates of withdrawal, dynamic spending strategies, asset allocation glide paths, tax efficient income, deciding what to sell and when, how to use pensions efficiently, annuities, bonds, cash flow planning. The list goes on. If you're ever going to work with a financial planner, make it be through retirement and don't wait to seek help because the closer you are, the less time there is to correct mistakes. Next, people in their late 60s or 70s. When you get older, you need to think about who is going to manage your finances and look after your family if you are not able to do so. Research shows us that cognitive decline leaves us vulnerable to making mistakes and falling for scams. It will happen to all of us at some point, and at first we won't notice it or will deny it. I'm sure you will have had experiences with your own parents or grandparents, and as they get older, you worry about them, their finances, and the cost of care. It's a burden. This is one of the main reasons why people choose to work with advisors. Even though they may be capable now, you never know when that might change. So they want to build a relationship with someone that they trust, someone that their family trusts, an independent professional with experience in later life issues, someone who can help facilitate these sometimes difficult intergenerational family conversations. And of course, try and help you save on inheritance tax. This is also often why they choose to work with younger advisors, who are likely to still be around when you're not. Next, higher earners. The more you earn, the more tax you pay, and the more opportunities there are to reduce it. What's more is that for higher earners, your time is extremely valuable. If you earn £200,000 a year, that means you're on £100 an hour. So for each hour that you spend thinking about money Doing the research, prevaricating over options, second-guessing your decisions, only to kick the can down the road, that opportunity cost is huge. As any successful professional or entrepreneur will know, you need to delegate everything that can be delegated to free up your time to focus on the big value items. That's why Richard Branson doesn't fly his own planes. So even if, given the time, you think that you could produce the same results as me and my team of chartered financial planners, I bet we can get you from A to B much, much faster. And if we can free up the time that you spend thinking about money, alleviate that stress so that you can direct your energy to furthering your career, building your business, or just unwinding with your family, that is a huge value add. Next up, those with larger assets. We like to think that as soon as we hit that magic number we have in our head, whatever it is, 500K, a million, 2 million, that's the point when things will finally start to get easier. That's the point when we'll finally feel financially secure. But those goalposts have a tendency to keep moving because as we start to accumulate more assets, the more complex our lives become. You start to realize that there's a burden there. There's much more of a responsibility. And at that level, the costs of making a mistake are much higher. It sounds mad, but the people who worry about money the most are those that have more of it. They still worry about not having enough, worrying about whether they're doing the right things with it, worry about losing it. Losing money hurts so much more than the joy that you get from making it. So yes, you can choose to go through life without paying an advisor a penny. But if you are filled with anxiety, consumed with worry about what you might be doing wrong with your money, that is a horrible way to live. Something that I like to say is that if you're still worried, you're not wealthy. The more money you have, the more complex life becomes and the more opportunities there are to make mistakes. At this level, even a single 10% mistake could pay for the lifetime fees of working with an advisor. This is why, for many, working with a good financial planner is more like an insurance policy. Not only because the downside risk of getting it wrong is so much larger than the cost, but because of the peace of mind that it brings. Next, business owners. Again, if you're a business owner, your time is precious, your situation complex, and there are many more opportunities to save tax. The common theme here is that the more complex your situation, the more opportunities there are to benefit from advice. But no matter how simple your situation is, if you don't feel confident investing or you find it difficult to make decisions, not only is this likely to create stress, but the financial opportunity costs can be huge. And if a financial planner can get you from 0 to 1, get you from cash to being invested, stop your analysis paralysis, and help you to make decisions decisively, the benefits can be huge. Research shows us that risk-averse people who use advisors tend to have between a 30 and 40% higher allocation to the stock market than those who don't. And they're more likely to stick with it during a crash. And over the long term, a 1% fee should be more than offset by the additional returns that are earned by a higher, uninterrupted stock market participation. Even with all of this, some people still struggle to see past the costs. Perhaps because they've done a projection that takes the money that they have now and assumes a rate of return, say 6% per year, to then work out how much they might have after a period of time. And then they look at the effects of adding a 1% fee. It's dramatic. In this example, after 40 years, you'd be left with £300,000 less. But this does not make sense because it assumes that you get absolutely no value from working with a financial planner. It assumes that in the counterfactual, you would have made every decision perfectly right on your own, which is highly unlikely. But what's even more unlikely is that you would carry on paying for a service that you think you're getting no value from for 40 years. You would never do that. So, what is the realistic potential downside? It can take a while to build a good working relationship and trust with a financial planner. So let's say after 4 years, you've really given it a go, you've invested in that relationship, but you feel that you've got no value from it at all. And you realize that you can manage perfectly well on your own. The downside is that you would have paid for 4 years of 1% fees, plus probably another 1% in initial fees at the start, putting the potential downside at about 5%. Now, you might be thinking, but what if they make bad investment choices during that time and you lose money? Well, that is why it's important that you work with a financial planner that follows an evidence-based investing methodology. Because if the investments are passive, it's hard to go wrong with that. What's more is that financial advice is a highly regulated space with a huge amount of consumer protection. All regulated firms have to have insurance that underwrites all of the advice that they give. So if the potential downside is 5%, what's the potential upside? What if, together, you make decisions that add the equivalent of just 1% per year? But what if it's 2%, maybe even 3%. Take this with a pinch of salt, because this is just a high-level illustration to help you think about the risk-reward payoffs of working with a financial planner. Just as with investment returns, you should not expect a planner's value to be delivered in a percentage basis every year. It will be lumpy, but it will compound over time in a similar way. To increase your chances of success, you need to make sure that you're working with a good financial planner. So how can you determine that ahead of time? That is one of the reasons I post videos on YouTube, to demonstrate the processes that we use at my business, the types of conversations that we're having with clients, and examples of the outcomes that we're delivering. So that before you even engage with us, you have a very good sense of what we do and what we stand for. And if you would like to find out more about how we might be able to help you specifically, there is a link in the description of all of my videos where you can book an initial call with us. So if you're looking for help, please do get in touch.